be really careful. And I said that a few weeks ago, shocking people, because, I was the one that's saying they were way behind and should have been tightening last year. And as they didn't, the inflationary pressures built up, and then everyone said, oh, my God, they have to tighten dramatically. And I think the market is almost over anticipating how much they're going to have to tighten. Look, all flexible prices. And now what I mean by that, the commodity prices, housing prices, freight prices that move up and down on a daily basis, they've rolled over. Now, the inflexible prices are wages, and they're still going up. They don't respond like like the stock market or the gold market. So we're going to see those wages continue to rise. But really, the anticipation of the Fed tightening and how high they're going to have to go, I think, is almost excessive now. I think the Fed has to be careful. I monitored the money supply, and, that told me that we were going to have all this inflation that we had. Well, the money supply has been brought to almost a dead stop this year, and that is unprecedented. And I said, 3 weeks ago, the Fed has just got to be careful not to slam on the brakes and just crash this economy. They've got to watch things. Yes, they have to raise, they have to ratify what's going on, but they have to realize that most of the inflation now is behind us, even though it's going to be going through the official statistics over the next 6 to 12 months.
Isn't that sort of the dynamic that you described in terms of wages remaining sticky and going higher and inflation rolling over? Isn't that a recipe for demand not necessarily to be destroyed as much as the Fed needs it to be in order to fight inflation longer term?
Well, I think that what's happened is because wages have not kept up with inflation. Really,
if inflation rolls over, then can it?
Well, what we're going to see, the sensitive, don't forget, these sensitive prices went up 20, 25, 30%. The CPI, as recorded, is up, 8%, 9%. So those prices are sort of coming down. They're still, workers have still lost a lot of purchasing power. We know about the decline in the stock market. We know the pessimism that we see in these, consumer reports. All these things are adding up to the fact is, yes, the Fed has to do some more tightening, but, maybe they're going to don't have to go to that 3.25% that the funds rate is projecting. We might get a debate about whether they're going to go 75 at the end of this month if the data continues weak. And if the data gets really weak, there might be a few people there saying maybe we should do 25. And that's a shocker, I know. But I'm just saying that, my look at the dollar. Look at Dominic was saying about, this is incredible. A 15% rise. That is an extremely tight market. That money is flowing in to get the high real rates that we have right over here in the United States. Real rates of interest have jumped up so much higher than the rest of the world. Hot money goes here. That's a deflationary also signal that's going on. Fed made a bad mistake, put in too much money. Can't slam on the brakes right now. Well, they're going to have to watch a lot of indicators.
As much as the Fed might be in a pickle, the ECB is in a worse pickle, Jeremy. And I'm wondering how you think about what the potential impact Europe's problem could be here in the United States and what policymakers do here. If the ECB hasn't even started hiking yet, they've only had hawkish talk, and this is what's going on. If the Fed is behind the curve, I don't know what you want to call it that the ECB is behind at this point.
Well, we actually had more money supply growth relative to trend in the United States and much more fiscal stimulus than they had in Europe. So we had that big initial impulse. Fortunately for the United States, since we are basically energy independent, we're not being as affected as Europe by what is going on in the energy market. So really, Europe is really actually suffering a supply problem. I never thought we had a supply problem. I thought we had too much money problem, and then too many people were trying to buy goods that couldn't be produced. They're now suffering a supply. They've got a really difficult situation there in Europe, and yeah, they're going to have to fight it. And I think a recession there is also inevitable given what's going on. Perhaps worse, much worse than the United States.
Professor Siegel, thank you for your take. Appreciate it.
Thank you very much, Melissa.
All right, coming up, media moguls, tech titans, all gathering in Sun Valley for the Allen and Company conference. An update of what investors can expect from this. Usually a lot of eminent. Oh my God, there's the biggest,
boss.
the biggest guy, the most important. Yeah. Plus new this morning. That's Brian Robert. Plus new this morning, and I just saw Reed Hastings, who not quite the swagger from recent years, you might think. Although I guess even stranger things is working. And senators on the Intelligence Committee urging the FTC to investigate TikTok. Details after the break. Squawk Box will be right back.